Somebody made a decision, a quiet one. No war, no disaster, no earthquake, just a policy, a rule change, a piece of paper. And then, a few years later, the entire world economy collapsed. 8 million jobs, gone. Families losing homes overnight. Banks that had survived 2 world wars, gone in a weekend. And it all traces back to that one quiet decision. But here's the part that should disturb you. It wasn't an accident. To understand what happened, you need to understand one thing about America in the 1990s. Everyone wanted a house, not just shelter. A house was proof. Proof that you made it, that you belonged. Banks knew it, politicians knew it, and they decided to use it. Washington had a plan. More homeowners meant more stability. More stability meant more votes. So they started removing the guardrails. One by one, quietly, no headlines. For decades, borrowing money was simple. Prove you can pay it back. Show your income, show your savings. Boring, slow, but it worked. Then the pressure started. Why should only wealthy people own homes? Why turn away a hard-working family over a credit score? It sounded like justice. It was a trap, but nobody wanted to say that. So the rules changed. Banks were pushed, then pressured, to approve loans they never would have touched before. No income checks, no down payment, interest rates that started low, then exploded. People signed. Of course they signed. The banker was smiling. The house was beautiful. Nobody explained what happened in year 3. But here's where it gets dark. Because the banks weren't naive. They knew these loans were dangerous. So why did they keep making them? Because they found a way to make the risk disappear, or at least look like it disappeared. They bundled thousands of these risky mortgages together, sliced them up, gave them respectable names and AAA ratings, then sold them to investors around the world. Pension funds in Norway, banks in Germany, investment firms in Tokyo, everyone was buying. And every time a bank sold a package, the risk left their books. Someone else was holding it now, so they made more loans, bundled more packages, collected more fees. The machine was running, and it was printing money. For a while. Here's the question nobody asked out loud. What happens when people can't pay? Because underneath all those polished packages, there were still real people, in real houses, with loans they could barely afford, and the clock was ticking. Across millions of American homes, those low introductory rates were about to expire. Monthly payments were about to double, triple, for families already at the edge. Some economists were screaming about it. Nobody listened. When a machine is making everyone rich, nobody wants to be the one who turns it off. Greed is patient. Until it isn't. 2007. The first cracks appear. A few thousand homeowners miss their payments. Normal, everyone says. This happens every year. But a few thousand becomes tens of thousands, then hundreds of thousands. And suddenly those AAA packages, sitting in vaults in Frankfurt, in Oslo, in Tokyo, start bleeding. Investors start asking questions. What exactly is inside these things? Nobody could answer. The packages had been sliced and repackaged so many times, so many layers deep that nobody, not the banks, not the ratings agencies, not even the regulators, could tell you what was actually in them. And when investors don't know what they're holding, they panic. The panic spread faster than anyone predicted. Because here's what most people never understand about the financial system. It doesn't run on money, it runs on trust. Every morning, banks borrow from other banks to operate for the day. They pay it back at night. The next morning, they borrow again. It's a river that never stops. The moment one bank stops trusting another, the river dries up. In 2008, trust evaporated overnight. Banks stopped lending to each other. Nobody knew who was holding the toxic packages. Could be anyone, could be everyone. So nobody lent to anyone. The river stopped. Then came the moment that changed everything. September 2008. Lehman Brothers. one of the most powerful investment banks in history, a firm that had survived the Civil War, 2 world wars, the Great Depression. It died in a weekend. The government decided not to save it. A calculated message: no more bailouts. Let the market feel consequences. The market felt them. Within hours, global stock markets were collapsing simultaneously. Companies couldn't access cash to make payroll. Ordinary businesses, factories, restaurants, shops found their credit lines frozen solid. The message Washington meant to send? Nobody heard it. The only message that arrived was 3 words: nobody is safe. Now here's the part that should make you angry. The people who built the machine, most of them were fine. Executives took their bonuses before the collapse. The biggest surviving banks received trillion-dollar government rescues. The ratings agencies that stamped AAA on toxic products faced almost no consequences. But the family in Ohio who signed a mortgage they were told they could afford lost the house, the savings, sometimes the marriage. The factory worker in Michigan whose pension had been quietly invested in those packages by managers he'd never met, his retirement was gone. The construction worker in Spain, whose whole economy had copied the same model, cheap credit, rising prices, endless borrowing, suddenly found himself unemployed in a country going broke. The machine's profits stayed at the top. Its wreckage fell on everyone else. But step back, because this story was never really about mortgages. It's about something older, something that's driven human behavior since the beginning: control, resources, and the fight over who gets to write the rules. The policy changes that enabled the collapse didn't appear from nowhere. They were built, carefully, over decades. Specific industries with specific interests poured money into Washington. They lobbied for deregulation, funded campaigns, placed their own people inside the agencies meant to watch over them. It wasn't a conspiracy. It was something more dangerous. It was a system working exactly as designed. When the people who profit from removing the guardrails are the same people who decide whether the guardrails stay, you already know what happens to the guardrails. And here's the twist that never makes it into the headlines. The 2008 collapse didn't just destroy wealth, it redistributed power. Large banks absorbed failing ones at fire sale prices. Surviving companies emerged with less competition and more market share. The wealthiest investors, the ones who still had cash when everything crashed, bought assets for pennies. Crises don't destroy power, they concentrate it. That pattern repeats across centuries, across empires, across every resource war ever fought. Chaos is a ladder, but only if you're already near the top. So what changed? Some regulations were tightened. New rules were written. Politicians gave speeches. Stern looks were exchanged in congressional hearings. But the core architecture? Still standing. Complex financial products still exist. Short-term thinking still drives bank behavior. The revolving door between regulators and the industries they're supposed to watch keeps spinning. And the gap between those who design the system and those who live inside it keeps growing. You are still living in the world that policy built. The ripples from that one quiet decision are still moving through your savings, your job market, your government's debt. So, here's the real question. Not who caused the collapse, not even how, but why does this keep happening? Every generation faces its own version of this story. A resource, land, oil, data, credit, becomes the prize. Powerful interests move to control it. Rules are written to protect those interests. Everyone else is told to trust the system, and then the system breaks, and everyone else pays. 2008 wasn't a failure of the market. Wasn't a failure of capitalism. Wasn't even a failure of regulation. It was a failure of power to check itself, which means the most dangerous question isn't about interest rates or banking policy. It's about who gets to write the rules, who enforces them, and who pays when they break. Because right now, somewhere, a new machine is running. New packages are being sold. New risks are being made to disappear on paper. And somewhere, a quiet decision is being made. No war, no disaster. No earthquake, just a policy, a piece of paper, and nobody is paying attention until the river stops.